50 or 25, 50 or 25, 50 or 25. I feel like it's the debate that we've been having for weeks now. That conversation seemingly endless, but the implications, of course, very real for market investors. So walk me through your latest thinking on what is going to happen later today. And of course, the primary focus is not so much on the size of the cut. You say it's on the messaging that we get from the Fed as well.
Absolutely, and I think you're right. We can debate 25 or 50 all day, but if you think sort of step back and think of the implications as an investor, I think the messaging is much more important because consensus expects a cut, right? Regardless of the debate is really only over the size and the pace over the next few months. In our view, obviously, when you have a larger cut, the key here would be confirmation of just what kind of path the Fed has in mind going forward. What are the data points that really sort of are weighing on their mind the most? Because at the end of the day, we of course believe a soft landing is possible, and that's part of the reason why we still want to pick and choose some of our risks. But to some degree, that's priced by markets and is predicated on a Fed rate cutting cycle that starts to bring down real yields and hence sort of supports growth, allows equity markets to focus on earnings. So I think more than the cut itself, the messaging about why they picked a particular size and what they have in mind, I think will be quite key to markets saying, okay, we're pricing in this rate cut cycle that seems sensible, or whether, we start to see some new worries on growth. I think for markets, that debate and that messaging will be what we'll be focused on the most.
Just for argument's sake here, given investors are watching this so closely, a 65% chance of a 50 basis point move. If we didn't see that happen today and the Fed opted for 25, could we see a material risk for risk assets here? Might we see a sell down if investors are disappointed on the size of the cut?
Well, I'd say you could get a bit of backpedaling in terms of what's priced. We have seen a move quite extreme, in one direction. We've seen, like I said, at least a pretty sizable probability of 50 basis points, and that's reflected in bond yields, for example, the extent of the move we've seen there. So a little bit of pullback is possible. We think that would be perfectly normal. It could trigger a little bit of volatility in equity markets, but again, that wouldn't be unusual. Some sectors like technology we think are ripe for consolidation, and seasonally we're in a weak period. But actually, the economic data, we'd argue, your inflation, retail sales, labor market data, they're softening, but arguably they're more supportive of 25 rather than a 50 basis point rate cut. I think it's a larger 50 basis point rate cut that the Fed may have to be at a bit more pains to explain that and to make sure it's read in a positive rather than a negative light. So to us, it might be one of the factors that leads to some short-term volatility. That's what our sort of allocations have been more prepared for. But I think that would still be perfectly consistent with a soft landing longer term.